A concern is, with the next administration, if Mexico and Canada, things are kind of changing. It's very fluid. If we put additional tariffs on China, are they going to retaliate? And if that happens, then yes, that is going to increase inflation slightly, and it's not good for the U.S.'s GDP.
Welcome to your Wiser Retirement Podcast. Are you curious about how Trump's economic policies will impact your portfolio? I'm Casey Smith. Today I'm joined by Andrew Pratt, Wiser's very own king of data. Each week we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe on Apple, Spotify, wherever you're listening to this podcast so you don't miss out. Let's get started. Hey, Andrew.
Good morning, Casey.
So this will be an interesting topic, and I want to make sure that we're really clear. I mean, we're doing this the post on Inauguration Day. So happy Inauguration Day, everyone. We're not necessarily endorsing Trump as a candidate, although we may or may not have voted for the man. But the reality is Donald Trump is going to be our president.
Yep.
And so we have to be able to navigate through his trade policies and tariffs and things like that going forward. I think I'm very excited. I see people that are being proposed for cabinets that are my age and not like 150 years old. And we've always done it this way, and this is how we do it. And I'm very concerned about in 10 years when 75% of our taxes.
He's definitely mixing it up.
75% of our taxes are going to go toward just paying our minimum interest as a financial planner. That's not a good thing. If it was our own personal finances, that would be detrimental, right?
Right.
So I think that we have a 2-year time frame of doing some radical change. If you look at GDP, how much of that is actually just government spending and has nothing to do with the free market is kind of scary when you think about it.
It is.
So basically, we've just had a manufactured, somewhat fake economy. I want to use that's a little strong.
Yeah.
But there's just a lot of government spending that could come back.
Right.
And allow private spending to go up, which allows for a much healthier economic environment going forward. It's just going to take a lot of old people in Congress and Senate who should have been retired by now to think differently. And I think that's your biggest headwind is how do you get people who don't want to change the establishment to make change? And so on that side, I'm like, I don't know. But the good news is we've had in tech world, they call it an A/B test, right? So we've had an A test where we've already had Trump as president for 4 years. And we've had Biden for 4 years, and people overwhelmingly chose a Trump economy versus Biden economy. So we'll see if that follows through. I think the chance of things being very positive also rely on Trump not being a buffoon when it comes to the pettiness that we had during the first administration.
Yeah, and I think just not being quick-minded, and if there's something that's not working, just being short-sighted and maybe try to let things play out. Not saying that that's happened before, but if something is not coming to fruition as fast as he expects, maybe just try to, pause and see if the policy, because you don't want, any of these new radical, I say radical, but these kind of outside the box changes to, you kind of want to see if they will play out and not to keep changing things, because that's not going to be good for the economy.
It's very interesting. The Elon Musk dynamic this time around. I don't know that in the first administration, they were very friendly. I don't think they were. No. The second administration, we've appeared to be obviously on much friendlier terms. And I think that Elon brings the younger generation, and what he's done in electric cars and space is absolutely amazing, right? And so I think that should have a positive effect, partially because the man doesn't need the U.S. government. In some cases, he's probably more powerful than any one single politician,
right?
Maybe even the president on some days, right?
Yeah, and you've seen other big, CEOs like Mark Zuckerberg and Jeff Bezos come into Trump's, Mar-a-Lago estate,
Well, they have to now.
Yeah, they have to now, but at least they're willing to have conversations and try to work together and not be, I don't say closed-minded, but
right.
they're trying to work together.
It's funny, Zuckerberg's out on social media now stating that the Biden administration would constantly call him and scream at him or his people about about posting negative things about Biden, and not him. It wasn't him personally. It's just it's just people on the platform, and it was like, oh, now you tell us that. Like, why wouldn't you tell us in the heat of the moment that hey, the government's doing this? So tell us after the fact. Which
his
is
hands forced.
Right, exactly. All right, so today we're going to focus on trade policy and tariffs. So let's start with the whole tariff thing. I mean, we've had a couple scenarios, kind of weird scenarios with clients that they're just really concerned about trade tariffs, and I will say, in full disclosure, that most, I say 99% of clients are concerned about trade tariffs.
Right.
But we've had a few that like focused on watching The View as their economic source of information, which I think is a very poor choice.
Yeah.
And the people on The View say tariffs are going to trash the economy, and very one-sided news articles also say the same thing. In your research, what are you seeing about what happens with tariffs? And let me make one more statement. This is something that I've noticed in the last administration, and then it's already starting again in this administration with Trump. And that's the grandiose comments of Canada might be the 51st state, right? We're going to buy Greenland. And what's happened is those countries, or I guess it'd be Denmark for Greenland, all of a sudden said, hey, Denmark's like, well, we're not about selling it, but we'd be happy to work on a joint venture on something. Canada's like, hey, how about we use some of our resources for oil and we could help you with that, right? So sometimes you come in as and I've done this before in times when I've had to negotiate business deals not related to Wiser per se, but the private equity fund that we had many, many years ago. Is you walk into the room as the craziest person in the room, and people look at you, don't know how to take you, and they become a little fearful.
Right.
And you use that advantage to then negotiate your position, which is usually somewhere in the middle. And so I see Trump doing that constantly, where he says crazy things and people take him verbatim. But in the end, he's trying to negotiate back to what his real point is, which we don't know what that is. Right?
Yeah. I mean, as you said, he is more business, taking more of a business approach to this. And I think, ultimately I think he knows, and I mean, he is a smart guy. He has smart people around him, that tariffs really aren't good, for the economy. And they don't really work. I think he generally is trying to use it as a bargaining chip. And, we've seen a few things already, like there's a Chinese auto, manufacturer plant that was shut down in Mexico. And then I think the Mexican president has sort of put some more restrictions on immigration. So I think, he is using tariffs more as a bargaining chip. However, some of these countries are coming out and saying, we're going to put retaliatory tariffs back on you. And, that's what China did. Actually, if we go back to his first term, Trump and the main goal he's doing this is he does want to sort of balance the, U.S. trade deficit somewhat. But, with China, during the first administration, he put on a 25% tariff on 60% of our trade. China actually, they have more flexibility and more, trade partners, and they were able to say, hey, we can retaliate and put, this 25% tariffs on your imports as well. So China was able to respond to that. So I think, a concern is, with the next administration, if Mexico and Canada are able, and, even if China, things are kind of changing, it's very fluid. If we put additional tariffs on China, are they going to retaliate? And if that happens, then yes, that is going to increase inflation slightly, and it's not good for the U.S.'s GDP.
What kind of tariffs are in place now with China? So
right now it's the 25%, which actually the Biden administration kept, 25% on 60% of our trade with China, and it's mostly agricultural. There's some other, I think, commodity, like I think there's some steel in there, but that's really what's in place right now. And then, I think going forward, it's sort of similar, but I think Trump actually a couple of days ago came out and said, instead of for Mexico and Canada, we're going to tariff all trade. It's going to be only critical imports. So, so yeah, it's changing. But I think he's being more thoughtful about it as of late.
Yeah. I think that's interesting though, because no one talks about the tariffs that are already in place with China.
Right.
It's kind of like the same with deportations. Obama deported a lot of immigrants, right? No one talks about that either. So right now we're at 25, we're 20% now. Is that right? Or 20, 25?
Yeah, sorry, 20%.
So we're at 20% tariffs. So really, we're only talking about increasing tariffs by 5%.
Well, 10% to China,
yeah,
potentially, and then 25% on critical, quote unquote, for Canada and Mexico.
So why do tariffs hurt the economy?
So tariffs, it's a one-time inflation effect. And, there's not a ton of research out on this, but I just looked at, and we actually have a graphic in here, CPI year over year changes during Trump's first term. If you look back during this time period, from where inflation started when Trump was inaugurated to its peak, it increased by about 0.5%, a little bit less than 0.5%. There was a good Goldman Sachs research piece that came out, and they pretty much said the same thing. They expect inflation to creep up, but it's going to be like 0.3 to 0.4%, and it's a one-time effect. So higher inflation definitely hurts the economy. So I think really,
but if you're a U.S. based manufacturer, it probably doesn't allow you to sell more of your product necessarily if you're competing with an imported product, but it certainly would level the playing field for you.
Yes.
If you're manufacturing, TVs would be a bad example. I don't think there's any TVs manufactured here, but maybe U.S. Steel is an example.
Right. Yeah. I mean, I think, short run, it's a little bit of a headwind, but more long-term, yes, it, should bring production back more into the U.S. And, increase manufacturing in the U.S. But I think that it's more of a long-term play.
Yeah. Well, it takes a long time to bring those things online. I mean, we're still working on a chip plant, right? In the U.S., it's taking a very long time to develop.
And I think, as we've seen, there's been a lot of volatility in the market since the election. And I think the markets are pricing in, this potentially higher inflation based on Trump's comments. And so I think a lot of that's baked in. I think what could really, be, I don't want to say detrimental, but, cause more volatility is unexpected inflation or, whether it's more tariffs, if he's not able to use it as a bargaining chip, as we think he could. So I think that's really the risk there. Yeah.
Do you think this happens day one?
So I've seen, again, there's not a lot of good research out here on this. From what I've seen, I think several things. Yes, that could happen on day one, or it could be a discussion point, because I think, and I can't remember the exact name, but it's the U.S., Mexico, Canada, I think Trade Act is supposed to be revisited in, I think, 2 years, 2026. So I think for one article I read, it could be like negotiation points leading up to that. So maybe that happens, or, maybe it's like a partial, who knows? I guess we'll see. But
because when he was in office the first time, he renegotiated NAFTA. Yes. North American Free Trade Agreement, right? Is that what's coming up for renewal, or is that something
this
different?
Seems like a different trade agreement.
What's the deal with Greenland? Why do we want Greenland all of a sudden? Do you know?
There's a lot of good natural resources there. I think the U.S. is sort of eyeing it as a good strategic position globally to have, I'll say a base, but like,
why would we
presence.
But why would we have rights to it?
Well, I think we're trying to purchase it from Denmark. And make them, a territory, or, if they want. But, I think from what I've heard on the podcast I listened to this morning is Greenland actually, they want freedom from Denmark and the U.S., but they're willing to more work with the U.S. But I think they see the U.S. as a better partner just from an economic growth standpoint, because I think they have, again, have a ton of natural resources that are not being, whether it's being mined or, they think the U.S. could bring a lot of, whether it's investment or
so they are territory
resources to them. Yeah.
Are they a territory of Denmark right now?
So as of right now, yeah, I think they're considered a territory, but they're technically under the Denmark government.
Let's talk about economic impact. You think it could be neutral when it comes to tariffs?
Yeah, I think really, again, like over the short term, it could be, the market again is sort of pricing this in right now, but I think over the long term, if we are able to produce more domestically, that could be sort of an offset effect. I think that's what some of these other studies, Goldman, Merrill Lynch, are saying. Maybe a slight hit to GDP. And again, this is one factor. There's lots of factors to GDP, but a slight hit to GDP in the short run, 1 to 2 years, but over the long run, it's going to be a net neutral effect.
Yeah. What do you think about GDP? If we're supposed to be trimming the government and cutting out all the fat, you think that would have a negative effect on GDP as well? I mean, if we're not doing $8,000 soap dispensers across the country, that $8,000 went to somebody's pockets, right?
Yeah, and I think, and we can talk about Doge now if you want, but
sure.
I think with this Department of Government Efficiency, their mission is, they have 3 stated goals, and this is on their main homepage that I found, and it's regulatory recessions, reducing regulatory constraints to help sort of spur economic growth and kind of make things sort of move faster for investment in Congress. Administrative reduction, obviously, there's a lot of overhead, whether it's DEI, and I won't say necessarily DEI, but like unnecessary, positions that don't really need to be there.
Right.
And then, just cost savings. Does the government need to be sending all this foreign aid to countries? Do we need, as you said, that there's programs there that, and I won't name specifics, but do we need to be spending this money there? So I think government spending does increase GDP, but it's, if it's not going to positively affect the economy, then that's where inflation comes in. And so, if their mission is to reduce wasteful spending, if they're able, and I think that's what they're going to recommend, we'll see if that gets passed. But yeah, if they can reduce wasteful spending and, cut costs, then that would actually be a positive contributor to GDP growth.
Yeah. Let's talk about taxes. So the last major tax change was during the first Trump administration, 2017. Right. That's set to expire at the end of this year, 2025. Right. What do you see happening here? It's
widely expected that Trump's going to extend these provisions. There's a lot of different elements to this. With individual tax rates, qualified business income, corporate tax rates, state and local tax deductions, childcare tax. So that there's a lot of different provisions. And I think, I was listening to you and Sean's podcast about this, but, whether Trump was elected or not, I think if a Democrat president was elected, a lot of this would have, been continued. A lot of these would have been continued as well. But I think now that there's just a higher probability that this Tax Cuts and Jobs Act program is going to get continued now that Trump is in office. He has his party in control of the House and Senate.
One of the things he talked about, and people go, "This is crazy," is not taxing Social Security at all.
Right.
So I did my own little research on that. You did as well. Mm-hmm. But taxing Social Security only equates to 1% to 2% of the total revenue of the U.S. government. It's a very, very small percentage. Yet the people, only 0.5% or half the people who take Social Security are being taxed anyway.
Right.
So I don't know. I think a middle class retiree is still paying tax on Social Security.
Yeah.
So it's a small drop in the bucket for them to not have to pay that tax, but it's certainly beneficial. But you do kind of wonder, does that cause inflation? If people have more money to spend, most likely they're going to spend it.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
As we may remember or have seen at one point in our lifetime, GDP equals consumption plus investment plus government spending plus net exports. So, I think, ultimately a tax reduction, both on the business level and, consumer level, if those individual tax rates remain at the same level or even potentially get lower, that drives up consumption inherently. And then that, goes back into the economy and that increases consumption. And consumption is about over 2/3 of our GDP. So that would be very stimulative to economic growth. And then also going back to, tax cuts. So Trump has come out, he lowered, I think, this was the first time that corporate tax rates were lowered in a long time. I can't remember the exact date, but maybe even back from the 50s. But corporate tax rates have been held constant around 34% for a long time. Trump actually cut that to, I believe it was, 21%. And then, now he's proposing potentially to cut it lower to like maybe 20%. But if you're, producing, if your products are manufactured in the US, it could even be cut to 15%. Again, this is just what he's proposing. So lower taxes mean more earnings, more retained earnings, which that means companies can invest more in the economy. So that's the I in the GDP equation. So that's investment. So obviously, that should again increase GDP if that were to happen.
People keep saying the tax rates, because of government spending, the tax rates have to get higher in the future, drastically higher. And some people are making, in my opinion, poor financial decisions today because they assume that there's going to be a 60% tax rate down the road, 10 plus years from now. What do you think? What do you think happens with taxes overall, long term, in relation to all this? Because if I don't think we're going to get a balanced budget in the next 4 years. Do you?
No.
So if we're not going to get a balanced budget, the government debt will continue to increase over the next 4 years.
Again, I feel like Trump would pivot if it's just say, whether it's if he cuts tax rates for individuals and business owners, and then just say like that happens, but then DOGE, just say they're reduce government spending too much, and that's not really sort of helping, whether it's economic growth or balance the budget somewhat. I feel like he would pivot to some degree. So maybe he would walk back, policies in different areas. But yeah, I think obviously he has a vision in mind of how he can make all these cuts to government revenue or spending to help balance the budget. But if that actually plays out, then I guess we'll see. But I feel like he would pivot. And I don't think he would, under his administration, raise taxes.
Right.
He might, maybe instead of, as we said, like the corporate tax, he proposed 15% for corporations. Maybe he doesn't go that low.
Right.
Maybe he just sort of mitigates that or kind of comes in the middle there.
Yeah, we still have to solve the long-term debt and I think he's given lip service to that, but I haven't seen any proposals that really solve the 10-year problem.
No, it is a problem for sure.
And maybe that's something that his vice president does if he runs for president in 4 more years. Maybe that's something he could tackle. But it's kind of a ticking time bomb. Again,
if Doge is and you have 2 billionaires, one of them, the richest man in the world, heading this department up. So I obviously have full confidence in their ability, but it is kind of a needle that you have to thread because again, government spending, while we need to be more mindful about it is, if you cut in areas that are leading to economic growth, that can be a detractor. And, you just got to be very careful where you cut spending.
Let's talk about how this affects portfolios. So how do you manage portfolios through what could be some radical changes in how we approach things in the U.S.?
I would say in general, we're just going to stay the course. We have a long-term vision and mindset on how we construct portfolios. We've done a podcast and have done research, in mid 2024 around this. You don't want to time the market because time the market's very difficult. And if you're tactically trading, moving in and out, you have to make 2 calls. And, studies have shown, going back to like 1950, if you stay invested, no matter who the president is, Democrat or Republican, you've averaged about an 8% annualized return. If you, stay invested only when a certain party, is president, that return is drastically lowered on an annualized basis. So, just from that research, we want to make sure we stay invested and sort of tune out the noise. And so overall, it's just want to stay focused on what your goals are, financial goals, and the long term. But just really just how it will impact the portfolio. I think, again, just kind of the short term, it's going to be, a little bit of headwind, although equities can generally pass through inflation. But I think it will be a little bit more volatile market just because Trump's going to try to get his cabinet in place. He's going to try to, he's going to try to make some drastic changes to how things are run in the government. So I think it's going to take a while to sort of for him to shape things how he wants it and for them actually to start producing results. So I feel like there could be some volatility around that. But I think in the long term, obviously lower tax rates are stimulative to economic growth on the corporation and business side. And then if Doge actually does a good job, that could actually help too. So I think they're at least, as you said, lip service to some of these big problematic areas and hopefully can address them.
And GDP, there's no really correlation with GDP and market performance. Just because you have an increasing GDP and the economy overall is doing really well, it doesn't mean that the market is going to follow suit necessarily. There's other risks that are out there.
Yeah. I think, and I probably should look into this. I think generally the long-term trends are intact, but there could be
short-term,
blips or, interest cycle, business cycle.
I think it was William Bernstein that said the stock market is in the short term is a voting machine. And in the long term, it's a weighing machine, meaning that there's lots of volatility, people voting with feelings. And there's companies that don't make it, but because in the long term, the ones that make it are the ones that are worthy of investing in. Which ones are those? Usually they're all listed in the S&P 500 for the most part. But you can always have things not related to politics. Enron was an example that derailed the market for a short time period.
Right.
But I go back to, whether he's successful in 4 years or not, people are still going to buy seats on Delta Airlines, United Airlines, American. People are still going to buy Coke. People are still going to travel, right? It's like our lives are going to continue as if everything is fine, right?
Right.
And so those are the companies that you're invested in. You're not invested in any one politician inside your portfolio.
Exactly.
So, and also too, is the style of investing. If you had loaded up on all green stocks when Biden was president, you're sorely disappointed right now.
Right. Yeah. And that's the thing. And I think we've talked about this in the past. It's like and I think part of it too is maybe like a run up. Back in 2016, everyone thought, energy and financial stock sectors would perform the best, but actually I think they were like some of the worst performing sectors. And there might've been, I haven't really looked at this, but I think there is kind of like a run up, pre-inauguration in some of these areas as well.
Yeah. I would argue that your oil trade, I don't think that'd be a very good one if you're trying to single that out, because his whole thing is reduce inflation, lower the cost of living for middle-class Americans, right? And that means lowering the price of oil, not increasing the price of oil.
Exactly. Are you talking about Trump? Yeah, and he wants to. And
typically, it's the wars, of all the other politicians that have pushed up oil prices, not anything to do economically, right?
Yeah, and if you think about supply demand, and although I've seen that production has actually been still very high in the U.S., we just haven't really kind of doesn't really feel like that, but. If Trump sort of puts more production online, because I think Biden did use a lot of our strategic petroleum reserve.
Yes.
So
if the reserve is way down, which is bad. But
right. But if you
but the Biden administration, when inflation got really bad, they had no choice but to drill, baby, drill.
Right.
Right.
Exactly.
So the last half of his administration, actually, you got to give credit there that they actually did start producing more in the U.S.
Yeah. And if Trump does, ramp up production anymore to, just say to fill the strategic petroleum reserve, then that's, obviously more supply. And if there's more supply, that means prices go lower. So that's not really, as you say, good for energy stocks.
Right. Exactly. It's funny because when you talk about, hey, what do you do in all these cases? People are expecting us to say, this is what you do with your portfolio. You got to switch this and you got to switch that. And you have to be on this side and you have to hedge this. And you all these really fancy words. That's not how it works. No. I was telling someone, I guess I was talking to our team yesterday, and I said, guys, portfolio management is really simple. Mm-hmm. The formula is really simple if you want to be successful. Unfortunately, the behavior that you have to have is really hard.
It is.
And that's the value of financial advisors, to make sure you're having the right behavior and not focus on doing the wrong actions. Right. And so it's just easier for some than others. Human nature typically sets in at some point, and you have self-doubt on, is this the right strategy? Am I doing the right thing? Market's down over the last month. People are, hey, should I be moving more to bonds? Well, no, you shouldn't be moving more to bonds because the market's down. In the short term, you're taking losses in order to buy bonds that are more higher in price right now, right? So that's sell low, buy high doesn't make sense to me. You need to look at these. If you're still working, these are opportunities. If if it's a volatile market, I hope that it's really down on your payday. And then that right. When you get your paycheck, then that percentage that went into the 401k plan, you bought more shares, because in the end, you want to buy as many shares as you can. If the market's down, you get more shares per dollar. They pay dividends based off of how many shares you have, not how many dollars right. or what the price of the stock is, right? So yeah, if you're retired, it's a little different game. And the portfolios are built differently, and the cash reserves are higher, and there's different strategies there. But when you're building wealth, and you're in the wealth creation stage, I mean, you don't want it to be horrible to where you lose your job. But hey, a good 10% sell off is a great opportunity to pick up massive returns over the long term. And people, we aren't wired to think that way normally. I'm just a guy that went through the financial crisis in 2007, 8, 9. And I kept a little bit of a journal during that time span. And when COVID happened, I remember digging through my desk drawer going, I kind of wrote things down a decade ago. And I went and I found it. And it was take advantage of opportunities. Don't be scared. That's kind of was the theme that I was writing back in 2008, 2009, looking back on it as we were coming out of it. I mean, we had a tremendous rate of returns in 2009. And I remember thinking, man, if we weren't dollar cost averaging or trying to work our way back into the market, we should have just been 100% market the entire time. It would have been scary, but we would have come out ahead of the average.
Yeah. And going back to that other point we talked about is, a lot of former colleagues and people that I know in the industry, from what they've said during that time frame, I was just coming out of school then, so wasn't really living through it. But it was easier to kind of sell during then, but it was hard to buy back in. Mm-hmm. And a lot of people missed out on a lot of return because they waited to buy back in because of that behavioral, those biases.
Yeah. And there's also professional biases like, inflation is going to be going crazy. We didn't see inflation for 17 years or something.
Right. And
all these people were short-term bond funds waiting for this inflation that never appeared until COVID, mm-hmm. really. So there's just a lot of things out there that are half truths. And if you tell yourself something long enough, you start believing it. That's just why we have you as the king of data, because it's the data that tells the story, not our emotions should never tell the story.
Right.
And when you build a portfolio, you have to build it based off data, historical data, but also future projections as well.
Right. And as you said, I think just for peace of mind, dollar cost average and systematically buying into the market just kind of can help some of these volatile moments and periods of time, and to sort of average out your cost basis
Right. If you have cash.
Right. Like a 401k.
But people talk about 401ks all the time. So a dollar cost average of the year. I said, no, you don't. You got paid. You invested 100% of the money right away.
Right.
That's not dollar cost averaging. Yes, you put money in over time. You got an average price, but you didn't have that money. You don't have December of 25's paycheck yet. So you can't say, I'm going to go ahead and invest that.
Right.
Right. So most people invest 100% when they get the money. That's what you do.
Oh yeah.
It's just you just get the money over time. So is that dollar cost averaging? I mean, I don't know.
Yeah. No.
To me, dollar cost averaging is when you have $500,000, maybe you inherited it, whatever, and you work it in over time. And I understand why people do that, because they're like, oh man, just want to dump all this $500,000 in right away.
Yeah, no, that's fair. And I think, there's laws that show that dollar cost average doesn't really help, over long term if you just pick up.
Vanguard has a great study saying that it's better just to invest lump sum. If you sell your business, it was fully invested in your business prior, so put it in the market 100%. The secret is having enough cash to where you never have to go into a portfolio in an emergency at the same time the market's down.
Right.
That's the secret of all this is cash management.
Sell the worst time. Yeah.
Yeah, exactly. Well, I digress. But yeah, thank you for going over this, Andrew. I think these are obviously not all the Trump policies. We clearly steered away from any of the things that aren't finance related. But I think we have a really good chance here to right some decade-long wrongs, economically speaking. And I hope that the old gray-haired guys and gals in Congress will realize that, hey, we're on a train headed to the wrong destination, and maybe they'll use this opportunity to make some change. My guess is that most of them will probably try to fight it, and that's sad. That's sad for our country. It's sad for our kids, but we can't keep doing what we've been doing. The good news is I love capitalism, and capitalism wins.
It does. If
they totally screw this up, and the next administration screws it up, people are still buying cola. They're still buying clothing. I mean, companies are always going to find a way to make money, and that's what the portfolio is about. How do we invest in companies that have good long-term prospects? And the S&P 500 is full of those.
Right.
Thanks for listening to today's episode. If you want to learn more about Wiser Wealth Management, you can do so by going to wiserinvestor.com. We also have a few related episodes. Episode 257 is the election outcome impact on crypto, Bitcoin ETFs, Bitwise files for index product. That's episode 257. 261 is the 25 market outlook navigating the year ahead. And we also have a video or a YouTube channel on YouTube. It's called A Wiser Retirement, same as the podcast. And we link to investing for income versus growth in retirement, finding the balance. I don't know how you invest for income these days. I think all those things are so overpriced, but people are still doing it. It's amazing.
Yeah.
All right. Thanks, Andrew. We'll see you next time.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced by Rachel Dotson. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.